In our current economic setup, savers are losers. Inflation works against you as the saver, where you are just not able to escape the domestic economy to enjoy wealth elsewhere. Last year, the CEOs of the top 6 banks earned about $150 million. We now have global debt at a much higher level than what it was prior to the 2008 financial crisis. The very people that you have put in charge to look after the financial stability of your country that determines your economic future are the ones with a conflict of interest making decisions is going to come back and bite us all in the... Start giving away some of that wealth to people. Just sidestep that entire process without being illegal. We are living in a dishonest illusion. You are living in the matrix. Except in this particular case, the matrix is the world that the banking systems has pulled over your eyes. Okay, let's have some fun. Hi everyone, thanks for joining. I really hope you're going to enjoy this video. At the end of this particular video, you guys are going to be central bankers, or close to it at least. I hope you can all see the beautiful background. It's a nice warm day in Cape Town. We've got Robben Island over there, mountain at the back. It's beautiful, it's warm. All right, so let's get started. At the end of this video, you guys are going to know what central bankers do. You can understand why regulators and banks and governments are actually not just custodians of your monetary and economic stability, they are also your jailers. Okay? Does that sound a bit severe? That is kind of the reality, okay? But you guys can understand all of those sort of things. So I really want you to just bear with me until the end, because then you'll be able to understand the role of Bitcoin versus the role of other cryptocurrencies and other blockchain solutions and things like that. Before we start talking about specific courses of action in terms of how you prepare yourself for the future, what investments you want to make, like I said, we got to start talking about the big picture, all right? And I'm going to describe that big picture to you now. I'm going to show you how money flows in our system, and when I show you that, you'll start to understand where the flaws are and why, when we talk about things like Bitcoin, why that starts to make sense. All right, so let's quickly go through this big picture. The big picture participants in any economic system would be us, the people, businesses, companies, banks, central banks, and the government. All right, so in a normal situation, you guys would deposit your money with the bank, right? That bank will use your deposits to extend loans of different kinds to different people, right? So Renee can go and swipe her credit card at a particular store. Hugo can go to another bank and get his home loan financed. And then what happens is, in the background, there's a central bank that helps to square off the obligations between the banks. So if I bank with FNB, Hugo banks with ABSA, and Hugo's a merchant, we are going to go and purchase some sneakers, then in the background, the obligation that I have towards Hugo will be managed by the central bank in the back end. So just the way we have bank accounts with a bank, banks have bank accounts with a central banks. The government has a bank account with the central banks. So the central bank plays a vital role in that background payments process to make sure all the obligations are cleared and settled between the various participants in our payment system. Okay? Hopefully that is clear enough. And then the other main piece in terms of money flows in the system is tax, right? And the tax goes to the government. The main forms of tax are income tax, VAT, which is, you know, when you purchase goods, and then there's capital gains tax. So if you made an investment that you bought low, sold high, generally you pay income, or rather capital gains tax on that particular capital appreciation. All right, so now I'm going to start getting into a little bit more detail, but it'll start making sense. And this, I'm going to start talking about something called fractional reserve banking and money supply. What is fractional reserve banking? It's very simply this. Banks are only required to hold a fraction of your deposits compared to how much money they lend out to others. Okay? In a normal situation, you'd think that they need to hold all of the money so that once everyone wants to withdraw cash, they can. right? And this is why banks are always afraid of this thing called a run on the banks, because they have more loans out there than deposits that they hold. Okay, so let's just start with a simple scenario where, let's imagine there's no money in the system right now. Okay, you guys all get 100 million currency units of salary and you deposit that into your bank account, right? Then what happens is the banks will take your money and use it to extend loans, credit card loans, personal loans, home loans, vehicle loans, you name it, right? But what they do is they lend more money than what is available. So in this particular scenario, I said banks lend out 500 million, okay? 5 times more than the deposits they hold. And what then happens is the overall money supply in the system, we call it the base money or narrow money, has now all of a sudden gone up to 600 million. It's a very simple thing. When Renee goes to a specific merchant and she swipes for 5,000 Rand, that 5,000 Rand was not there. It came from credit that was extended to her by her bank. There's an additional 5,000 Rands in the system right now, okay? It's a very simple concept that illustrates that the extension of credit increases the amount of money in circulation in the economy, okay? But now what also happens is that all of us, where we have our salaries and deposits sitting in a demand deposit account at a bank, we don't enjoy any interest on that, right? But the banks will use that money, extend multiples of that money in terms of loans, and earn interest on that. So in this particular scenario, let's just say 10% is the interest that they've earned. They've extended 500 million currency units of loans out there, and they've earned at 10% 50 million, right? You've earned nothing. If the banks extended 10 times more money than the deposits they hold, they will earn 100 million currency units. You've earned nothing. And in the process, with all of the amount of money that they are pushing out there, they could potentially increase inflation and potentially devalue the currency. All right, so the more money is out there in circulation in general, there's a certain degree of correlation with the inflation. And inflation basically refers to the reduced purchasing power of your money. So next year, the amount of money, or rather the amount of goods your money can buy you is less. That's really what inflation is all about. The main thing here, though, is that the banks will have earned 100 million currency units of interest using your money, and you've earned nothing. Okay, I want you guys to just remember that. That is very important. Let's just take this a little bit further now. Let's go to the government side of things, right? Governments have to spend money on various programs, military, defense, health, education, sanitation, things like that. And occasionally they need money too, right? So what do? They go to their central banker and they ask for a loan. Let's say they ask for 100 million Rand, 100 million currency units. What they do is they issue a bond for 100 million, let's say over 5 years, at around 4%, which in our particular South African economy would be considered low compared to the amount of interest you have to pay back on your home loan. Imagine if you were able to pay back your home loan at 4%, wouldn't that be wonderful? No. So the governments are able to do this. They can issue a bond at very low interest rates. Why? Because they are considered to be risk-free. The amount of money that can be extended to banks can enjoy those low risk, those low interest rate loans, because the loan is basically secured against your tax money. Okay, every single year, governments will just get more and more tax money as inflation goes up. Make sense? So it's pretty risk-free. And in addition, I mean, this is not technically accurate, but it's roughly true. Governments can influence central banks to just print more money. And by printing more money, there's more inflation that happens. And with more inflation, they will just get more revenue next year. All right. So they are fairly risk-free in terms of extending loans. So in our scenario, let's say, for example, the inflation rate is about 5%, right? What happens? In year one, on that 100 million currency unit bond that the government issued, they have to pay back 4 million in year one, 4 million in year two, 4 million in year three, and so forth, up until year 5. But in year one, let's say they've earned tax income of 50 million. With inflation at 5%, next year they're going to earn 52.5 million. The year after, they're going to earn more than 55 million. In year 5, they're going to earn nearly 61 million. Meanwhile, the 4 million payback has remained the same. So what is happening here is inflation is automatically making governments' lives easier, right? Because they don't have to work hard for their next increase the way all of us do. They just need to sit back and allow inflation to play out, right? But what happens on the other side? You guys, you're trying to thrive in a very difficult economy. You put your money into some kind of savings vehicle, and let's say you get a good return of 8%, right? In a 5% economy, 5% inflation economy, what has really happened? The real value, the net value you've actually made has only gone up by 3%, 8 minus 5. Because even though you've got an 8% return, everything else is 5% more expensive. Do you understand? So inflation works against you as the saver, as the investor. In our current economic setup, savers are losers, okay? The government, the debtor, is a winner in the current particular setup. Make sense? Okay. So inflation, even if it is low, like 5%, it doesn't have to be like in Venezuela or Zimbabwe or Argentina where you've got hyperinflation before you feel the effects and the price of bread is more expensive this afternoon than what it was this morning. It still hurts you in the bigger scheme of things, just not as drastically and as immediately as it does in some of the other countries where we've got hyperinflation. Okay, so I want you guys to remember that. Then what happens is, because governments are able to rely on inflation to just continuously subsidize their debt obligation, there's no problem. They can just continue to extend, or rather ask for more loans, because inflation is just going to take care of their debt obligations next year. That's how it is. And as a result, we can now have Eskom being bailed out, no problem. You, the savers, and the taxpayers are the ones that are actually bearing the brunt of those reckless spending decisions. Okay, now I want to get into financial repression. You guys really need to go and research this term, financial repression. Those airplanes are loud. I hope it's not going to be too bad for you guys. What is financial repression all about? Financial repression is a system of regulations that ensures that your money, your tax money, your savings money stays in this domestic economy, and very little of it is able to escape out there in order for you to enjoy benefits out there. If you wanted to invest in dollars because you think the rand's going to depreciate, or if you want to invest in property in the UK, whatever the case may be, some kind of capital control will be in place to limit how much money you can take offshore. Okay? That is one example of a bit of regulation that restricts your economic freedoms. And in some countries it's worse. I mean, look at what happened to Argentina last week, where the amount of dollars per month was reduced by between 50 and 100 times. Okay, that is what we refer to as one tool, one regulatory tool in the process of financial repression, where you are just not able to escape the domestic economy to enjoy wealth elsewhere, all right? Your money needs to be kept here so that it can perpetuate this cycle where governments can enjoy, through a process of inflation, their debt being subsidized or liquidated using your particular savings. But let's go into that in a little bit more detail. The banks themselves are also obligated to hold government debts. There's not really much that they can do, because in the background, like I said to you guys, you've got banks that have bank accounts with the central bank. And let's just cut through all of the technicalities. The central bank can simply debit one bank's account and credit them with a government bond. That is it. Okay? There's no choice in the matter. So governments have to hold on to these particular government bonds. But the thing is, the very important thing is this, guys. They do not have to worry about the loss that they make on those low-yielding government bonds. Why? Because they just take money from customers, their demand deposit accounts, their bank accounts, and the interest that they enjoy by extending loans, they'll take that interest to just offset these losses on the low-yielding bonds, government bonds, and earn some fat profits in the process. And at the same time, governments are just able to continue spending the way they do. So that particular piece of regulation, which is actually quite important because it's the way the central banks control the money supply. They need to create a liquidity shortage in the market in order to control the money supply. So that is just the way the central banking mechanics work, all right? But the net answer is the banks just fall out of the middle in terms of this particular process. And what's left is that savers and taxpayers subsidize ongoing government expenditure. Let me give you an example. Last year, the CEOs of the top 6 banks earned about $150 million, excluding the share price depreciation. 6 CEOs, guys. Imagine how much money all of the banks and the executives in the banking industry around the world are making based on the fact that they just take customers' money and use it to extend loans, increase the money supply, drive the credit bubbles, all those kind of good things. Okay, so imagine if all of that wealth was given to the people as opposed to being enjoyed by the bankers, all right? And then one other important point that I want to make here is that governments have a monopoly on the issuance of fiat money, on the issuance of money. Let's not get technical. That's a very important point. They have monopoly on the issuance of money. Not you and I, governments, okay? That's what fiat money is all about. The problem is they are also the ones that are most conflicted. They have a conflict of interest. Why? Because they are net debtors. And as a result, they have the privilege of just printing more money, creating more money, right? Technically, they influence the central banks to do that, but that's the net result. So you've got this conflict of interest where you've got governments, the bulk of whom are in debt, having the monopoly to just issue, or rather print more money to continuously get themselves out of debt. And as a result, we now have global debt at a much higher level than what it was prior to the 2008 financial crisis. Do you understand the fundamental flaw that we have here? Okay, the very people that you have put in charge to look after the financial stability of your country that determines your economic future are the ones with a conflict of interest making decisions that will impact you, and it's going to impact you. It's not just in Turkey or Venezuela or Argentina where things are playing out more drastically. This is going to impact us. These financial, monetary tinkering and shenanigans that are taking place right now is going to come back and bite us all in the arse, okay? Central banks will generally try to do what is necessary, but they get influenced. I mean, in Turkey, the central banker was removed by the president because, you know, there was a conflict in terms of their opinion about what had to be done. In the US, you've got the Fed guy Powell being ridiculed by Trump the whole time because he's not dropping interest rates enough. They succumb to political pressure. This is what happens. Okay, so that central bank independence thing, it's just not there anymore. And it's working against us. All right, guys. So now I've explained to you financial repression. All right. I'm now in a position to say to you why an alternative like Bitcoin is the right one. So now I just want to mention one more thing. Okay. Yesterday I saw HSBC putting out an advertisement on Bloomberg where they talk about the technology innovation, you know, internet-based banking, same thing with Bank Zero, where their claim to fame is they've got minimal back-end costs and things like that. And, you know, even close friends of mine would ask me, but, you know, Time Banking is doing this, Bank Zero is doing that, you know, isn't that the way to go? What they don't get is that the same oppressive structure is still at play. No matter how they automate their back end, they are still using your money to make money. This is why I say, and I know it sounds awful, banks don't work for their money. Every single day that people go to work in a bank, they are not working for your money. What are they doing? They are working to maintain a system and possibly grow a system, but that system is one that is based on using your money to make money for them. Okay, that is what is happening. So they will put in disaster recovery procedures, have multiple data centers, they will enhance their IT and provide more functionality online. That's great, yeah, lovely functionality, right? But it doesn't change the fundamental business model in the background, which is use your money to make money for them. So there's nothing revolutionary about it, okay? Nothing. It's just more tech. Start giving away some of that wealth to people who are enabling you to do this, then maybe we can talk. Yeah. So just before I move on to the solution or the alternatives, do you guys remember that movie, The Matrix, where Morpheus handed Neo a choice between the red pill and the blue pill? I'm going to read to you what the red pill and the blue pill is all about, because I think you will you'll appreciate what message it is that I'm trying to get across to you here. So the red pill, together with its opposite, the blue pill, is a popular cultural meme, a metaphor representing a choice between the red pill, representing a life of harsh knowledge, desperate freedom, and the brutal truths of reality, and the blue pill, representing a life of luxurious security, tranquil happiness, and the blissful ignorance of the harsh realities of life, basking in an essentially dishonest illusion. Guys, we are living in a dishonest illusion. You are living in the Matrix. Except in this particular case, the Matrix is the world that the banking systems has pulled over your eyes. And it's time for you guys to get unplugged. And how are you going to unplug yourself? This is where we are going to talk about Bitcoin. All right, so now we can start talking about how we escape the financial repression and the limitations, the capital controls, all those things that I was talking about earlier. And what I'm going to do is I'm going to show you guys simple pictures in terms of how we can overcome these things. Let's just start with two pictures, in fact. Let's imagine that you are living, for example, somewhere in the US and someone else is living somewhere in Europe. You would like to be able to take your money from the US to Europe, for example, right? You would have to go through the existing banking system, which I'm going to take you through now. And part of that will involve having to go through various exchange control processes in order to convert your currency from dollars to euros, right? And then just for good measure, I've included a few other bodies in there, your correspondent banks, the SWIFT network, because I'm just simply trying to illustrate to you guys that it becomes excessively complicated in terms of moving money between jurisdictions. Okay, now, the alternative that I was talking about earlier, let's just get straight to it. That alternative is the Bitcoin network, all right? The Bitcoin network lives outside of these geographical structures that we have to abide by as people. Bitcoin does not see country borders. Bitcoin does not see jurisdictional areas. It lives completely outside that in a virtual world that is not controllable by anyone, that is not owned by anyone. And so what you can really very simply do is go to an exchange and convert your dollars to Bitcoins, send your Bitcoins to anyone else who lives in Europe and reconvert them back into pounds or euros, whatever the case may be, and you are done. Okay, it does not live on top of any of the existing banking legacy infrastructures. It lives outside of that, and it is brand new. All right, and a very important thing is that you cannot regulate Bitcoin. When you purchase Bitcoin in the States, that is a domestic transaction. But with this particular mechanism here, what has happened was by reconverting the Bitcoin back into euros somewhere else, you've just converted a domestic transaction into a cross-border transaction, not needing to go through any of the exchange control regulations that you normally would, not having to abide by any of the exchange control regulations. You've just sidestepped that entire process without being illegal. Okay, so that is a very, very significant thing, and it is very different to something like, let's say, Ripple. Ripple is running on top of these additional, or rather these legacy banking systems. Okay, the same thing with Libra. Libra will run on top of the existing banking systems, the existing payment trails, and will be backed by the existing set of currencies. Bitcoin is completely different. It does not need to integrate into the banks. It can operate without the banks. It does not need to ask for permission from a regulatory authority. Okay, it is completely independent, and that is what it makes it special. So going forward, companies like Sayo will be building solutions on top of the Bitcoin network. And it's early days, guys. I mean, who would have thought that Facebook back in 2000 would be what it is today, right? So getting into Bitcoin-based applications is like getting into Amazon, getting into Facebook, getting into Google in the early days of the internet. All right, and that is something that is, it's very important for you guys to understand. This is the way in which you can free yourself from the regulatory constraints that has always been there.